Hi there. If you own agricultural property in the UK, this is for you. You'll see how APR is changing. I work in UK tax planning.
Welcome to this Fairview Accounting Services Explainer. If you're a UK farming family business owner, or really, if your estate relies heavily on agricultural assets at all, this is absolutely the most important briefing you're going to watch this year. Today, we're getting right into the newly confirmed inheritance tax rules around agricultural property relief, and exactly what they're going to mean for the future of your farm.
Section 1. The costly APR mistake. Let's start by addressing a specific and, frankly, incredibly costly oversight. You see, for decades, the absolute best, most sound tax planning advice you could get was simple. Just hold on to your farm until death. But relying on that outdated rule today is now the single most expensive mistake a farming family can make.
I want to ask you directly. Is your family's succession plan currently relying on the old belief that agricultural property relief automatically means a £0 inheritance tax bill? Because if it is, the loop on that protection has just been firmly closed by HMRC.
To really understand the stakes here, just look at the stark contrast. Historically, you had the absolute comfort of unlimited, 100% relief on qualifying agricultural assets. It honestly didn't matter if the farm was worth £1 million or £20 million. But the post-2026 reality? It's entirely different. We are moving to capped relief. Estates that confidently expected to pay absolutely no inheritance tax could suddenly face hundreds of thousands of pounds in liabilities. And the concrete consequence of getting this wrong? It's families literally being forced to sell off generational land just to settle a tax bill.
Section 2. The £2.5 million cap. So, what is the actual rule replacing this unlimited relief? Let's look at the core mechanism of the new legislation and see exactly how it targets asset-rich farming estates.
The crucial date you need to have circled in red on your calendar is the 6th of April, 2026. That's exactly when these new rules take permanent effect.
From this date onwards, the 100% agricultural property relief, along with business property relief, is strictly capped at a combined £2.5 million per individual. Make no mistake, this is a hard limit. Now, you're probably wondering, what happens to the value of your farm above that threshold? Well, any qualifying agricultural assets that exceed that £2.5 million mark will no longer be fully exempt. Instead, they're going to receive a drastically reduced relief rate of just 50%.
And this perfectly illustrates the harsh maths behind the policy. When you apply the standard UK inheritance tax rate of 40% to that halved asset value, it creates an effective tax rate of exactly 20% on all your excess agricultural assets.
Now here's where a lot of people get quite frustrated, and it's important we understand the context. The government's stated intent, as noted by the DEFRA secretary here, is to target larger estates while protecting ordinary family farms. But the reality on the ground, many working farms are going to be caught right in the crossfire. Why? Because agricultural businesses are inherently asset-rich, but often quite cash-poor. A working farm can easily breach that threshold in land and machinery value alone, regardless of the actual profits it's generating.
Which brings us to Section 3, the spousal transfer rule. Now let's interrupt that rather bleak picture with a completely counterintuitive truth. This next rule shifts the mood from panic to strategic planning, and it's absolutely vital if you're a married farm owner.
This is the spousal transfer rule. Just like the standard nil-rate bans, a married couple or civil partners can actually pool their individual allowances. This means a husband and wife can combine their limits to completely protect up to £5 million of agricultural value from the new tax.
But here is the really crucial point where most people get confused. This transfer applies even if the first spouse passed away before the April 2026 cutoff. Their unused £2.5 million allowance is still fully transferable to the surviving spouse. However, to maximize this, you need strategic will planning right now to ensure your assets are structured to actually utilize both allowances effectively.
Section 4. A £10 million farm example. Let's look at a worked example and see how this builds in practice. Walking through the actual maths is always the best way to remove the fear of the unknown. Imagine a farming couple with a total estate value of £10 million. First, they apply their combined spousal allowance of £5 million, which receives the full 100% relief. So that leaves £5 million of value exposed. On that remaining $5 million, the new 50% relief rate applies, which brings the taxable amount down to £2.5 million.
Finally, we apply the standard 40% inheritance tax rate to that 2.5 million. The result? A staggering final inheritance tax bill of £1 million.
If you're looking at a liability like that, HMRC does offer a mechanism to manage it. You have the option to pay this tax bill in up to 10 equal annual installments, completely interest-free. However, let's be realistic, finding £100,000 a year out of typical farm profits is still a massive cash flow burden. Because of this, many families will now need to seriously consider life assurance policies specifically designed to cover this new cash flow requirement upon death.
Section 5. Your crucial next step. So, the rules have changed, the maths is crystal clear, and the stakes are undeniably high. Let's transition to the one practical action you need to take.
I want you to spend just 30 minutes this week doing exactly this. Step 1, locate your most recent professional farm valuation, and make sure that includes land, buildings, and machinery. Step 2, compare that total figure directly to the £2.5 million threshold or the £5 million threshold if you're married. Step 3, assess your exposure. If you are over those lines, you have a looming tax liability.
Knowing your numbers today is your greatest asset. Early planning gives you the time to restructure ownership, review existing trusts, or carefully consider lifetime gifting well before the April 2026 deadline hits. Once that date passes, your options are going to narrow significantly.
I'll leave you with this final thought. The era of unlimited, automatic, tax-free farm succession is officially ending. Is your succession plan genuinely ready for the maths of 2026, or is your family's hard-earned legacy currently left exposed? Thank you for joining me for this Fairview Accounting Services Explainer. Please get those valuations out, check your numbers against the thresholds, and take control of your planning this week.